Let's hear what Tom Lee has to say about this market.
Stock ideas for this month is Fundstrat Global Advisors Tom Lee, a CNBC contributor. Welcome back.
Great to see you, Scott.
All right, first, your view right now on this market is what?
I think that markets are showing some relief that CPI was dovish, and actually I think some of the inflation prints the last 2 days have been dovish, including PPI. So it's setting the stage for yields which kind of were close to touching 5% to kind of cool. And at a time when sentiment's been negative, I think we should be rallying.
Is the Fed back in the game? Which means this report was good enough, these two reports, really, as some are saying that, okay, you're not going to get a cut in January, but you could get one in March. And some people had written cuts off for many, many months.
Yes. Into this CPI print, the whisper number for core CPI was over 0.3. So the market was bracing for a really hot number. And you could see it in the Fed fund futures where, as of yesterday, there was a 30% plus chance of a Fed hike. I think those sort of extreme views have been quelled. And I just think generally, without counting for the fact that the California fires could mess with inflation, the inflation print over the next 3 months is going to be a lot lower than what we saw November and October. And remember, January to March of last year, it was close to 0.4. So I think inflation is setting up for some good comps.
Okay. How optimistic are you for the type of return we could do this year after back-to-back, 20+% gains for the S&P?
We've gotten some good harbingers so far because the first 5 days of this year, the S&P is positive. So I'd say there's an 80% chance of something over double digits for the year. And what's going to matter to a lot of people is how we do for the month of January. But as of January 15th, we're up 0.7%. So those are good harbingers for the year.
Can we have a good year if the Fed doesn't cut until later in the year and bond yields remain elevated for a while?
If bond yields get stuck here, it is a severe tightening of financial conditions. And I think it's going to hit housing, and we're already seeing it now. So I think it is important for yields to move directionally lower.
That's a long way of saying stocks will not be good if bond yields stay where they are now?
Yes, it's going to test the market's resolve. I don't think it kills equities, but it's hard for someone to be pounding the table if they think yields are going to be stuck at close to 5% for the next 6 months.
Wow. So if yields, let's just say they stay near where they are now, you wouldn't be as optimistic as you are?
I think it's going to raise concerns. There's a policy error from the Fed, that either financial conditions are too tight or the bears will argue the Fed made a mistake cutting too aggressively last year.
But isn't this the base case? I mean, you have what is arguably a more inflationary environment because of some of the policies that are being talked about by a new administration. Sure, they may stimulate more economic growth, but with that potentially comes more sticky inflation too.
Well, there isn't necessarily a connection between growing faster and more inflation. There is some inflation that can be generated by tariffs, and that's the uncertainty.
Well, that's what I mean also. It's like tariffs, it's inflating the deficit. It's just reinflation. It's the reinflation trade based on some of the expected policies that may cause that.
True, but to keep in mind, last year's inflation, first of all, a lot of last year's inflation was what they call imputed because it was just statistically catching up to the price changes of the years before, but it's housing and auto insurance were 80% of the inflation over the last 4 years. And the third is labor markets, which we know aren't in an inflationary position. So in order for new policies to generate inflation, they have to be powerful forces that fiscal spending hasn't generated the last 3 years. So I'd say that it's difficult for me to make the case inflation is getting strong.
Okay, so let's talk stocks, specific names. Your top 5 stock ideas for January of 2025. NVIDIA is at the top of the list. Stock is not traded well. Why is it going to have a great January all of a sudden?
Well, NVIDIA is been mean reverting because it did have a huge move and now it's cooling. And I think it's earnings season is going to just affirm, I think, visibility about how much companies are repositioning around the value creation around AI. So to me, NVIDIA is a name you want to own for the next 3-5 years. And the fact that it's at 130, I think is actually an attractive pullback.
Okay, you like Meta, you like Amazon, you like Alphabet. We don't even need to discuss. I think everybody probably knows the reasons why. However, JP Morgan is on that list as the only of the banks. Now, obviously, it's having a great day today on the back of earnings. Why'd you single out JP Morgan? You could have picked others too. Why didn't you?
J. Morgan is one of the best executing banks. To me, banks should be re-rating higher. I mean, they survived a gauntlet of stress tests over the last 4 years, and they're producing strong earnings in the midst of a yield curve that was inverted for a while and now uninverting. And the company spends a huge amount of money on technology. So I actually think JP Morgan should see its multiple expand.
Do you like the banks in general? I mean, do you see what's happening today? It's not just JP Morgan. I mean, Goldman Sachs up like 7%, Wells Fargo, Citi up at least 7%.
I think the big story arc is banks haven't really caught up since the GFC. So to me, there's a multi-year period where banks are going to do very well. And this is a risk-on environment with animal spirits coming back and capital markets picking up. So it should be good for all banks.
Stocks to avoid: Intel, Airbnb, Alibaba, Verizon, and Nike.
Intel, Airbnb, Alibaba, Verizon, Nike. Those 5 names Tom Lee does not like.
So Nike's just not going to be able to get out of its own way still, or what?
Well, these are 1 month views. And so, yes, I think it's in the absence of a fundamental catalyst. I think many of these have been already companies with not clear visibility and weakening fundamentals and poor price momentum. So I don't think they're stocks I want to be trying to pick up.
All right. Good to catch up with you, Tom. Appreciate your time today. As always, Tom Lee. Fun
Great seeing you,
strat.
Scott.
All right. So Tom Lee, to give him credit, again on Monday, he said he thinks the bottom is around 5,700 on the S&P. We bottomed at 57.5, at least for the week. And we're seeing this momentum lead into the end of the day.